My view is that every major bubble, except for rare third world and Weimar Republic, when you lose a war and go bankrupt and then borrow overseas, it's usually overseas debt that causes a hyperinflation. That most bubbles burst with deflation because debt, and financial assets that build up in a bubble disappear, and then that causes not only assets to deflate and debt, but also spending and businesses and unemployment and everything. So I see deflation, even though there will be inflation down the road, I see deflation as the most likely outcome here when we crash. Now, two important cycles. 90 years since stocks started and the Industrial Revolution, and Harry met Sally with democracy and free market capitalism, greatest explosion ever. The stock markets have been going up exponentially, and this is a log chart and it's still exponential, but the one trend that is crystal clear that stands out, 90-year super bubble and then great reset cycles. 1837 to 42 after the great Midwest expansion. I'm not going to get into what the governments did to stimulate there. And then the 29 to 32 bubble crash, which everybody knows, and now the greatest bubble, the most global ever. So we're right in that. In fact, we're about a year late on this because they've been stimulating so hard to avoid it. Another important cycle. Stocks tend to peak a little less on cycle than they bottom. Generation bottoms had come in 42. Henry Ford generation, 82 Bob Hope generation, and now baby boom, late 2022. I have been predicting since the 80s when I was super bullish that we would see the lowest stock prices of our lifetime at the end of 2022. And I still say that. It just might be a year later because of all the money printing to stall on that. My important breakthrough indicator from demographics and inflation is the 4-season cycle. Generations drive booms and then bust, and then inflation is driven especially by high workforce growth, which the baby boomers exaggerated, and of course immigration cycles do as well. But here's the key point. We hit the peak of the fall bubble boom season in 2007, went into a deep downturn that started to look like a depression, and they didn't know what to do. You couldn't get people to borrow more. They borrowed off the charts, businesses and consumers and governments in the boom. So they found out, you just inflate, quantitative easing. If you keep printing money, at least financial assets go up, okay? The reason this hasn't caused inflation is going into financial assets, not consumer spending, and we're in the winter season, 2008 to 23, which I've been forecasting for decades, when deflation, falling demographic trends, which is deflationary when it's spending trends falling, and high weight of debt and financial assets that weighs on the economy and eventually has to deleverage and wants to. This is why we've been printing 25 trillion, now well over 30 just after COVID, adding that. We can't create inflation because we're in a deflationary era. If we'd done this sort of printing money in the 1970s, we would have had hyperinflation. Last time we had a big bubble, the debt bubbled up and then it deflated, not government debt. Governments always go more into debt when there's a crisis because they have to fund everything and bail everybody out. 62% of private debt was deflated after that 29-30 bubble peak. Now we see the 2007 peak later, and what happens? We barely deflate at all. In fact, new debt's being created, particularly in emerging countries. So we haven't deflated the debt, which takes the excesses out and allows unproductive investments to be cast away so we can grow again, especially when demographics turn around. Now, what I've been saying for years, they started printing money and they said, this will be a short-term crisis. No, it's a long-term demographic and debt crisis, and nobody's dealing with it, so they're printing money to cover it over. And I said, it's going to take exponentially more. They just printed in the last year since the repo crisis a little more than they did in the entire QE cycle before it, over 80 months in just 8 months. So it's taking exponentially more. And guess what? No inflation. Printing money at this rate, anybody that says, and Milton Friedman was dead wrong about this. He said inflation is entirely a monetary phenomenon. Well, not anymore. We've been printing unprecedented by any measure, and all we get is 1.3% inflation, and the Federal Reserve is praying for 2%, and they can't get there. Inflation was going up even faster before the money printing. Then it went up at about the same rate, and money printing got higher and higher, didn't budge at all. And then when they tapered in 2017-18, inflation kept going up, and now they've just shoved it up the roof, and inflation is still doing the same thing. It's going up. Gold tends to go up when they print money because the assumption, which rightfully normally would be, you print a lot of money and it's going to, and especially if it goes into consumer and business spending, it's going to cause inflation. But remember, it's not going into consumer spending. Everybody's spent out, or only the wealthy are spending more. And they happen to be, the top 20% happen to be 50% of spending. That's the only reason we're growing. 4% growth in the up end, and on the bottom 80%, zero growth. But it's financial assets. But gold went up, especially with the money printing after late 2008. And then when Japan tripled down on money and the inflation kept falling, gold finally fell into late 2015. And it's rising again because money printing is stepping up. But again, I keep saying, where's the inflation? I've been saying literally out in public, it'd be impossible to create high inflation and really impossible to create hyperinflation in this global and US deflationary environment. So again, what's really happened, what really correlates with money printing is financial assets go up. Stocks, bonds, real estate, those sort of things, and especially stocks, because stocks are the highest return and benefit the most. Stocks have gotten 6 times GDP when normally is about 3-ish, okay? So just to come down and reset, stocks have to fall 50% in value. That's $61 trillion of financial assets that will disappear. So my view is, again, why did you get deflation in the 30s and not in the 70s? Because we had a great reset out of a bubble. Financial assets disappeared and did not come back for a long time. Debts, 62% we saw, were restructured down, money disappearing again. And then, of course, unemployment and business failures and bank failures and less spending as well. But the biggest thing was the disappearance of financial money, not bank accounts, but financial assets and debt.